Welcome back to Grip News 2M, your trusted source for financial news and investment insights. I'm your host, Daniel, and today, we have an exciting topic to discuss that has been gaining popularity among investors: index funds. If you're wondering how to invest in index funds and take advantage of their numerous benefits, you've come to the right place. So, let's dive right in. Before we jump into the nitty-gritty of index fund investing, let's start with the basics. What exactly are index funds? Well, an index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index, such as the S&P 500 or the Nasdaq. These funds aim to provide investors with broad market exposure, allowing them to passively invest in a diversified portfolio of securities. Now that we know what index funds are, let's explore some of the key advantages they offer. One of the main benefits of index funds is their low-cost structure. Since they aim to replicate an index's performance rather than actively select individual stocks, they typically have lower expense ratios compared to actively managed funds. This cost efficiency can have a significant impact on your long-term returns. Another advantage of index funds is their inherent diversification. By investing in an index fund, you gain exposure to a wide range of companies across various industries, which helps spread out your risk. This diversification can be particularly beneficial for investors who want to minimize the impact of any single stock's performance on their overall portfolio. Now, let's discuss how you can get started with index fund investing. The first step is to open an investment account with a reputable brokerage firm. You can choose between a traditional brokerage account or a tax-advantaged account such as an individual retirement account, IRA, or a 401k if available to you. Once your account is set up, it's time to select the index fund that aligns with your investment goals. Research different funds and consider factors like the fund's expense ratio, historical performance, and the index it tracks. Popular index fund providers include Vanguard, BlackRock, and State Street Global Advisors. After choosing the index fund, you need to determine the amount you want to invest. It's crucial to consider your risk tolerance, investment horizon, and overall financial situation when making this decision. Remember, consistency is key when it comes to investing, so try to contribute regularly to your index fund to benefit from compounding returns over time. Finally, it's essential to periodically review your index fund investment and make any necessary adjustments. Rebalancing your portfolio and staying informed about market trends can help you ensure that your investment strategy remains aligned with your goals.